I'm going to call the December 8th, 2022 Audit and Finance Committee meeting to order. First item is approval of minutes for the June 9th, 2022 meeting. Any changes to the prior meeting minutes?
No, sir.
No, sir.
No, Jackie. Can I have a motion and a second to
I move to
those?
approve.
Thank you.
I'll second.
Thank you. And I have a motion and a second. I'll call the question. Ms. Meads?
Yes.
Ms. Thurlow?
Yes.
And I'm a yes. That passes. I'll call Ms. Weinberg up to talk through the investments.
Good afternoon. Okay. So I'm going to be giving an update as of October 31st on our portfolio, but I decided to split it into two. First, to show the snapshot of where we are as of September 30th, to show the full fiscal year, and then that's the first part of my presentation. At the end, I'll discuss October, just because it's only 1 month of the new fiscal year. So I will first discuss the market environment. As we know, the Fed has increased 6 times this year, and it's just been a very steep increase in order to curb inflation. And the Fed funds rate is now at 3 3/4 to 4%. And keep in mind, the Fed started increasing at the beginning of this year. We started increasing in March, but before that, we were for 2 years at 0%. So this has been a huge, steep increase. Global growth is expected to decrease to 2.1% in 2023, which we're currently at 3.3%. However, we are expecting inflation to decrease to 6.5% from 8.8% currently. Now, wage growth did increase this year, and the labor market has been incredibly strong, but it has not been keeping up with the inflation. And this is symptomatic of a high inflation environment. Economists are predicting an 80% chance of recession towards the end of 2023. Now, the good news from a district perspective is that where we invest, which are mortgage-backed securities and agencies, mortgage-backed securities are at 6.7%. Versus 2.5% last year, huge jump, and agency securities are at 5.5% versus 1.5% last year. So these are tremendous increases. Our investment strategy: the district earned $5.1 million in fiscal '22, and we budgeted $3.8 million. Now, if we invest with our new ad valorem funds, as we're seeing them trickle through, we receive 80% of ad valorem between December and January. If we invest $100 million, say $50 million in mortgages and $50 in agencies, at the averages that I mentioned before, 6.7% on the mortgage side and 5.5% on the agency side, we'll earn pro rata about $4 million in additional income for those 8 months if all investments are completed in January. So that's taking from February through September, 8 months. This year, we did have to liquidate our money market funds in order to cover expenses because we've been spending down our fund balances. Now, I did want to mention we always keep money markets liquid because we've always done this. This is nothing new. And as we get towards the fiscal year end and before ad valorem comes in, we need to bridge the gap and pull from those money markets into our operating account and cover operating expenses. This year, we had to liquidate all of our money markets, which we've never had to do that before. But the reason is we're spending down the fund balances. And to give you an example, last year, our portfolio was at $524 million at fiscal year end. This year, it was at $395 million. So that's a $129 million decrease that we've spent in fund balance. This just shows our key interest rates, and as you can see, we've jumped quite steeply, and we invest in the 5-year Treasury. As of September, and these numbers are already stale, it's already changed, but we were at 4.06 as of September 30th, and we trade as a spread to Treasuries, to 5-year Treasuries. So mortgages are bringing us 144 basis points above this 4.06, and Treasury agencies are bringing us 144 points above this 5-year Treasury, and mortgages are bringing us 264 basis points above. So it definitely behooves us to invest in these particular securities. However, in addition to these rising rates and rising consumer prices, they outpace the wage growth. This eats away at consumer wealth and decreases disposable income. And once again, it's just setting the stage for a recession next year. And as I mentioned, these rates have already changed. The 5-year is now not 4.06, it's 3.62%. And the 10-year and the 30-year are also declining. Rates are higher on the short end because we're in an inverted yield curve situation right now. It remains to be seen what happens with rates next year, whether they remain or the Fed decreases. There's different thought processes on that. But if rates do decrease, we do invest in different structures to protect us. And what that means is when we invest in a callable bond, if I invest in a 5.5% bond and say then rates are at 5%, I'm going to get that bond called, and then I have to reinvest at 5%, so at the lower rate. So what we do is we invest in, we have different call protection options, where we have like a 3-month lockout, 6-month lockout, 1-year lockout, so that protects us. That means that no matter what rates do, the issuer cannot call that bond away from us. But that's called call protection, and that costs us in the form of lower yield. But it's good to have those in your portfolio and ladder them out, because if you don't, you'll get all your bonds called at one time in a lowering interest rate environment. Now, mortgages do not get called, but we receive principal and interest every month on our mortgages. They have what's called an embedded call option, which means that in a decreasing interest rate environment, people refinance their mortgages. So we get a huge influx of cash. And well, we would get an influx of cash. And in a rising interest rate environment, the cash slows down. We invest in something called planned amortization classes, PACs, that keep us in a window. So we're always in that 3 to 4 year window where we know we're going to get our money in that time. So what that helps with is we're not subject to, or at least I should say, it helps mitigate extension risk and contraction risk, because we don't want to purchase a mortgage and then we're stuck in it and that's not allowed per policy anyway. And we don't want contraction risk where we get the money back so fast that then we have to reinvest at lower rates. So there's other investors and other tranches that we get our set money, and if there's extra, other tranches get it. They absorb the risk. And if there's not enough money, we get it first. So again, risk return. We get a lower yield, but we're not taking on the risk. Other investors take on the risk. This is a snapshot of fiscal 22. As you can see, there's a huge gap between our cash invested, our investment balance and cash balance. We're at 87.54% in investments and 12.46% in cash. This is hugely skewed, and this is primarily because we had to liquidate the money markets. And that's just going to skew your numbers completely, because obviously our bonds are still there, but our cash isn't there. And again, because we had to liquidate money markets. But once we start receiving more ad valorem funds, and you'll see in my later slide, and when I discuss October, we're already seeing these percentages switch. Our target is 70% invested and 30% in cash and cash equivalents. Also, the other thing I wanted to bring your attention to is that typically the yield on cash and investments is a lot lower than yield if I just showed investments alone. Because investments alone, you're just taking that, you're not absorbing the cash drag, which you would from when you include cash and investments together. But they're not, the spread isn't that there because of 2 reasons. One, again, our cash balances were low. And 2, our funds were invested by February of 2022. So, and really the yield spiked between June and November. So we didn't have the cash to invest, to take advantage this year. We will next year, once all of our ad valorem comes in. What we don't do is we could have sold the portfolio and then invested at higher rates, but we would have taken tremendous losses, and we're not going to do that. So that's the reason our yield looks so low. This is our portfolio breakdown. We were, as I mentioned, $395 million as of the end of September. Again, you see the cash balances are very low. And the other thing I wanted to bring your attention to is our mortgage percentage is 52.48%, which is a lot higher than we typically would have. And this isn't because I purchased new mortgages. This is, again, because the cash was lower, and it simply skewed these numbers. These are our benchmark comparisons. On the cash side, because we liquidated the money markets, they were earning between 2.5% and 3%. So I took money out of those to cover expenses, put them in the operating account, and then they covered expenses, but the operating account is earning us 1%. So that's why we see that lower than the index. And then also on the investment side, typically we beat the index, and typically we beat a lot of our peers. Now, I see that, as you can see, we are in line with where our peers are. So that tells me they're in the same position, they're doing the same thing we are. But what jumps out is the 1 to 3 year Treasury index is at 4.3%. And the reason for that is we're not a buy, sell portfolio. That's not what we do. We cover project expenditures, income second. So as I mentioned, we were already invested, so we didn't have the funds to invest and take advantage of these higher yields. Whereas the index, they don't have to worry about that, and they could just ride up that yield curve and just keep putting money into these higher yields. So that's why you're seeing the 4.3 on the index.
Lucy, previous page, we talked about, sorry, can you flip back one?
Sure.
We talked about more actively sweeping from the operating account into the money market. And given the liquidity of the money market, which is daily.
Yes, daily.
Yeah, I mean, and it's giving us 200 basis points more yield, then, I'm assuming we can do that, we can implement that fairly quickly.
Oh, yes, absolutely.
Okay. All right, good.
Absolutely. And once more ad valorem funds come in, that's when I'm going to replenish those money markets at the 3%, and they're at 2.5% to 3%, which is a lot better than the 1% on the operating, which we just had that increased on September 1st from 0.10%. But the operating account acts like a checking account, and banks don't pay on those kind of accounts. This is my last slide. This shows the October 2022 summary, and this shows you our investments and cash equivalents is getting more into line. Invested is 79%, cash and cash equivalents is at 21%. Again, our goal is to be 70-30 split, so that's our target. Also, as I mentioned earlier, we liquidated $20 million in bonds to cover expenditures. I liquidated 2 bonds. I sold 2 bonds, 2 $10 million blocks. And unfortunately, we had to take a loss on those because the market is, say, at 5.5%, and I'm sitting on a 1% bond that I'm trying to sell it. No investor is going to buy a 1% when they can get 5.5%. So in order to entice them, you have to sell it at a steep discount. And hence, we took that loss. But we will recover it as we get more ad valorem funds. We're seeing them flow in quite nicely. And we will be able to make a significant amount of interest income with these higher rates and take advantage of them.
And part of this has to do with the velocity of projects that we're doing.
Yes.
And the contracts that we have to pay out on
Yes.
on a quicker schedule. So we also talked about, you guys are working on a process whereby, the planning will change to reflect that pacing. Whereas we want to avoid, obviously, we had to, but we want to avoid selling the bonds.
Absolutely.
Okay.
Absolutely. That's like a last case scenario. And Candy mentioned in our briefings that what we do is we upfront the money, and then we get the money back from FDEP, but staff has been terrific in really garnering a hold on that and really tightening that schedule, so we're going to get the funds back faster. So we won't see this sort of predicament in the future. And then my last slide is just the references from where I've procured my information.
I have just a couple of quick questions.
Sure.
So, how do you prepare for a recession? So 80% tells me that you prepare for it. Is there something differently we do now to prepare for a recession at the end of next year? And then the other question is, and you know, I have a tendency to be rude, and I don't mean it to sound rude. It's just the way I ask questions sometimes. How did we get caught with a bond at 1% when the market went to 2%? Is it because we had to hold it for a certain period of time before we cashed it out? Is that, I'm not accusing you of
No.
anything, is what I'm trying to say. I just don't understand the system.
Because when we purchase bonds, we don't do it all at one time, and you never know what rates are going to do. So we've got bonds on the books at 2 3/4, 2.5, and then some, like this, the 1% was bought back in 2020. So, and if I would have sold it, which I inherently had to anyway, which I didn't want to, but to cover the expenses. So we did have to take the loss, but it was the least loss we can take, because if I sold a mortgages are a lot higher, we would have taken a much greater loss.
So if we typically, we will always hold to maturity,
Yes.
unless those are called or semi-called in the case
Yes.
of mortgage-backed securities. And so, but we keep that maturity at a low, it's 5 years or less.
It's
What's our
actually
average now?
3.
3.5?
It's actually
Yeah.
3 on the whole
3.5.
portfolio. Per policy, it can't extend.
So we're still at our legacy pre-Fed move rates in the ones, but as Lucy puts money to work, that will be at the higher rate. So we're always going to lag.
Yeah. And I'm sorry, what was your first question?
How do we prepare for a recession now? 80% tells me that
Yes.
we should prepare for it now.
Well, how we, from a portfolio perspective, we diversify. I mean, we diversify because we never really know what rates are going to do. I mean, some are saying they're going to remain as they are. Some are saying they're going to decrease. So, you know, you really never know. No one has a crystal ball. So that's why I'm a fundamentalist. You can never beat the market. I've studied that, I've learned that you can't beat the market. So the best way to do is to diversify your portfolio and diversify unnecessary risk and mitigate your risk as much as you can. And then you're not going to have bonds called and have to reinvest at lower it's just an overall diversification of the portfolio. And that's very important. Does anyone have any other questions?
No? Thank you, Lucy.
Thank you.
Appreciate it.
Thank you.
Oh, sorry. Any public comments or questions, Molly?
There are none, Mr. Chairman.
Okay, thanks. Thank you.
Thank you.
Lucy. Mr. Behrens, to talk about the Inspector General audit reports. The first one is the audit of the ERP. Do you want to, Tim, is it easiest just to sort of go through the summary page?
Yes, I'll do that.
Okay.
Since I won't go through the background, since you already have,
Don't know.
okay. Since you're already familiar with the process, I'll just give you what the audit results were. Okay. So the audit was to determine how well our ERP enforcement process was working, and overall we found that the process is working as designed. There's 2 primary functions that they have to do. Number 1 is when complaints come in and knowledge of violations are received, staff follows up on them, and if there is turns out to be a violation, they take enforcement action on those, which could result in either getting the permittee to correct the problem, or there could be fines if to enforce and induce them to make those corrections. The other is looking for unpermitted work, and there is no database that gives you that information. So what staff does is they go out with periodic helicopter flights, and they have the district divide up in different regions, and each month they will go and do surveillance flights of the different sections of the district to see if there's any unpermitted activities going on out there. There's a very limited staff that is carrying out this function, and so they are stretched fairly thin. They have done some cross-training to help to assisting with that workload. So we made a couple recommendations about to assess the adequacy of the staffing of this function, and also to explore any possible technological solutions that could be employed to help enhance the staff productivity. And with that, I'll take any questions.
Mr. Lipish.
Thank you. I do have a question. Would you go back to your slide? Thank you. Just for those who may be watching this at another time, could you please repeat or say what ERP stands for and what it is?
Environmental Resource Permit. This is, I'll just go back here. What an environmental resource permit is that it's a permit that's required if anyone wants to go out and do modifications to lands that might affect the flow of water on lands, such typically developments. Developers, they have to come and get a permit from us before they can go in and start moving dirt around on property, for example.
Right.
changing the water
And
flow.
so for me anyway, this is an extremely important part of the responsibility of the South Florida Water Management District. And
Yes, it is.
I appreciate what you've done with this, but
You turned off.
I'm sorry. I appreciate what you've done with this, but would you mind, if it's proper, to talk about what kind of technological things could be done to alleviate the issue with the staff? I know you made recommendations, but I think this is really important. I mean, in the old days, I believe environmental permits were determined by the board. And at one point, they were turned over to the executive director because they had meetings like we had today where they lasted like 2 days. But I would never, this is such an important thing, and I'd like to make sure that we're on top of it.
Okay. Yeah, your staff had a few ideas of their own, and such as when they go out in the field and have tablets, if they could have them connected to where they could get GPS information and that sort of thing, that would be helpful to them.
Thank you.
And Tim, were there, I guess when we were going through this, one of the things that was very clear was the lack of resources, both people and budget. Because what we've been, it seems we've been constrained by those two things, and what's happened is we're reacting to complaints that we hear, or reports that we hear, as opposed to sort of proactively going out and checking compliance. And in fact, it sounded to me, correct me if I'm wrong, we're looking more at unpermitted work than we are checking the compliance of permits. So in addition to the technology providing more efficiencies and sort of improvements around compliance and enforcement, are there any, was there a budget ask as well?
If they were to actually do proactive monitoring, it would require significantly more staff, probably several times what they currently have.
Yep.
Last time we did this audit, I think maybe 7 or 8 years ago, it was the same conclusion, that we're still basically in the same place.
So Drew and Jen, maybe we should look at whether, like, do a sample study and look at whether we're missing, and maybe you guys have already done this, whether we're missing significant compliance, and which would then tell us, yes, we need to really think about growing this team.
Sure, that's something that we will continuously look at. I'd clarify one thing. We do compliance regularly on our permits. Of course, there are limitations on how often. You can't be out there all the time, but we do inspections on all of our permits. And so what I think I might clarify is that it's likely that the unpermitted activities, so those are mostly going to result from a complaint, right? But those unpermitted activities are probably more likely the ones that result in enforcement because they've just done something without a permit. That's going to be more likely to end up in a consent order and penalties, where when we're doing compliance, we should be catching it on the front end and keeping it from going down the enforcement path.
Okay, so that is happening?
Yes.
Okay. Yeah, sure.
What happens to the money that comes from penalties, from unregulated permitting? Can it not go back into the budget of the people who, this budget?
That's a good question. It does come into our budget, but oh, thank you. Save the day.
I hear budget and I perk up, yay. So, yes, ma'am. The money that comes in, those collections that come in, they fall into your balances and they help offset your expenses. So, under fees and other, we have these revenues budgeted to cover some of the expenses in the regulatory staff. So it does come in and it does go back in to fund the regulatory functions.
Any other questions? Molly, any public comments?
There are none, Mr. Chairman.
Yes.
Can I have a motion or a second to approve the audit of ERP enforcement?
I move to approve.
Thank you,
I'll
Cheryl.
second.
I have a motion and a second. I'll call the question. Ms. Meads?
Yes.
Ms. Thurlow-Lippish?
Yes.
And I'm a yes. That vote passes unanimously. Mr. Behrens, the audit plan for next fiscal year and long-term audit plan.
Okay, our plan approach, we start with going through the current strategic plan, the next year's fiscal year's budget, and we look for those programs and activities and functions that we consider present potential risk to the district. And when we talk about potential risk, it's what could go wrong. It's formed as a question. And also the amount of time since the last program, that program was audited, and obtaining input from executive management and board. So with that, this is the audit plan in one snapshot on one slide, where there's 3 sections. We call it the specific audit projects, the recurrent audit projects, and then there's usually a couple administrative things that we're required to do. So this year's includes fixed asset processes and procedures. This was basically all the non-real estate assets that we have to keep an inventory of. Audit of investment management, this will be looking and making sure our portfolio is in compliance with our policy. Audit of the recovery program and looking at where we are in terms of expenses and deliverables in that area. Audit of operation, maintenance, inventory, and processes and procedure. This would be primarily at our field stations where they maintain an inventory, a lot of parts and materials that they need to do their work. So these are usually consumable type of items. The audit of consumptive use permit enforcement, which we're doing that as a separate audit since it's a separate process. And then audit of land lease compliance. This is we'll make sure that the lessees are in compliance with the provisions in terms of the leases that we sign with them. Network perimeter security audit. This is a IT audit. Make sure that our IT resources are adequately processed and that our security team does those those processes that are needed to protect our information. And then an audit of the e-permitting system. Then the recurrent audit items, monitoring of construction change orders. We'll have another update for that for you in March. We monitor procurement credit card transactions, negotiated contract work orders, and then we do our quarterly follow-up, investigation complaints that come in, and then anything that may come up during the year from executive management or the board that needs some immediate attention, we make provision for that. And then the administrative projects, we're preparing the audit plan for the following year. The annual report, which we're currently working on for the FY21, which we'll have before the end of this month. And then the last time I forgot to get deleted, that was actually done this year, and that's the next item on our agenda. I have a slide on all the objectives on each one of these, but Mr. Chair, if you want, I can just skip to questions and discussion.
Yeah, I
Or
think
I can
this
go
is.
through each one if you'd
You know,
like.
we've talked, at certain points, we've talked about each one of these, and I think.
Right.
I'm assuming you actively engage with executive staff on prioritizing. So I think we're good. Any questions, comments from the committee? No? Molly, any public comments?
There are none, Mr. Chairman.
Okay. I'll call the question on the approval of the audit plans. Ms. Meads?
I move to approve.
Ms. Thurlow-Lipish?
I'll second it,
And, I'm sorry,
right?
did we do, I need
A motion.
a motion and a second. We-
Yeah, I move to approve.
And so
I'm
I-
getting
I-
ahead of myself,
It's okay,
sorry.
I
It's clo-
second
It's
it.
closing in on 5
I know, we're
PM.
all like,
Now, may I have the vote, please? Ms. Meads?
Yes.
Ms. Thurlow-Lipish?
yes, it's hard with 3 people.
And I'm a yes as well. That passes. Mr. Burns, to continue on the external quality control review, this is where other folks in the industry peer review, right?
Right.
You want to just go to the summary, if you have a summary page?
Yes, we can do that. So someone once asked me who audits the auditors. This is the answer to that question. And we are periodically required to have, every 3 years, a peer review done. It was done through the Association of Local Government Auditors. And the requirement is actually, the statutes required us to follow government audit standards, and one of those standards is having this done every 3 years. We use the Association of Local Government Auditors as a professional support organization, and I won't go into detail on that. And they provide a couple people come do our review, and we volunteer to go do others. All we do is pay for the travel expenses. The review result can be either a pass with deficiencies, or failure. We received a pass compliance report. And here's a copy of the report with the opinion that based on the results of our review, it is of the opinion that the South Florida Water Management District Office of Inspector General's internal quality control system was adequately designed and operating effectively to provide reasonable assurance of compliance with government auditing standards and applicable legal and regulatory requirements for audits during the period January 1st, 2019 through December 31st, 2021. So with that, I'll take any questions or comments.
Sure, yep.
Tim, I just want to thank you for all of your work, and I know we're going through this quickly, but we've all been briefed, I've been briefed, and you work so hard and do such an excellent job, and I am sure you always get A-pluses from those who are judging your work, the work of the district, and thank you very much.
Thank you.
I'll echo that. I'm happy but not surprised that you passed the peer review process, and I hope when you have to travel, you get a interesting and fun location to go to.
Well, I was just in
As opposed to the Dallas
Chattanooga.
Fort Worth Airport.
Yeah.
I love Chattanooga.
Yeah. Well, this is a non-voting item, so I think we're good. Molly, any public comment?
There are none, Mr. Chairman.
Okay. And any public comment at the end of the meeting here?
There are none,
Didn't
Mr.
think so.
Chairman.
Okay. So next Audit and Finance Committee will meet on March 9th here in West Palm Beach. And thank you, everybody, for spending your extra hour here tonight. And happy holidays and a very, very happy new year. adjourn the meeting. Thanks.